This week in SaaS, the real story was not product launches. It was money. It was regulation. It was investor confidence. And it was a growing fight over who actually captures value in the AI economy. Because while a lot of people are still talking about AI like it's one big rising tide for software, the market is getting more selective. Adobe had a brutal week. Software deal making is under pressure. Retail investors are still buying the dip. Alibaba is experimenting with a different AI monetization model. Nvidia is trying to own the profit layer, and IBM just made a very expensive bet that the infrastructure behind AI may matter more than a lot of the flashy apps that are out there. So if you want the headline for the week, it's this: software is being repriced in real time. Welcome back to This Week in SaaS, where we break down the biggest stories in software for the past week and what they actually mean for markets, business models, and the future of the industry. Let's get into it. Let's start with Adobe, because Adobe just gave us one of the clearest warning shots in software. First, the company agreed to a $150 million settlement with the US government over allegations tied to subscription cancellation practices. That includes $75 million in civil penalties and $75 million in free services for eligible customers, along with an injunction tied to how those practices are handled going forward. Then, almost on top of that, Adobe said longtime CEO Shantanu Narayan will step down once a successor is named. The stock fell sharply after the announcement, even though quarterly revenue came back in at about 6.4 billion, above expectations. Reuters reported investors remain worried about Adobe's positioning in an AI disrupted market, and the stock is already down sharply this year after another steep decline in 2025. And that's the real story here. This is not just an Adobe problem. This is a signal that the old SaaS model is under pressure from two sides at once. On one side, regulators are taking a harder look at subscription mechanics, cancellation friction, and customer treatment. On the other side, investors are asking whether incumbents can still justify premium valuations if AI changes how software is built, priced, and consumed. For years, SaaS got rewarded for recurring revenue and high retention. Now the market wants more than that. It wants proof that you can defend the model in an AI-first environment. It turns out sticky revenue sounds a lot less charming when regulators call it hard to cancel. The second big story is that software sell-off is no longer just a sentiment story. It is now affecting actual corporate activity. Reuters reported in February that the sell-off in software stocks has been disrupting some M&A and IPO deals because falling valuations have made price discovery much harder. The S&P 500 software and services index had dropped roughly 25% from its October peak, and bankers said buyers were worried about overpaying while sellers were reluctant to accept lower prices. That means a lot because once valuation confidence breaks, everything slows down. Acquisitions get harder, IPO windows get messier, boards get cautious, private equity gets pickier, founders start clinging to stale marks from a better market, which, to be fair, is one of the most durable traditions in tech. The bigger implication is this: the market is no longer treating software as one giant premium category. It is separating the companies that look structurally advantaged in AI from the ones that look exposed. And that repricing has consequences far beyond stock charts. It creates what gets funded, what gets bought, what gets built, and who gets left behind. Now, here's where the story gets more interesting. Even with all that pressure, retail investors are still buying software. Reuters reported that retail inflows into software stocks hit a record in early February despite growing AI disruption fears. The iShares Expanded Tech Software Sector ETF took in 176 million over a 1 month period ending February 9th, according to Vanda Research, more than double its 2024 peak. So what does that tell us? It tells us that retail investors are still looking at this sell-off and seeing opportunity, not collapse. Some of that is probably simple dip buying instinct. Some of it is belief that the market overreacted, and some of it's likely a bet that the biggest software platforms will adapt, absorb AI, and come out stronger. That creates a real tension in the market. Institutions are asking, is AI going to compress software margins and weaken moats? Retail is asking, are these just discounted quality names in a panic cycle? And honestly, both sides have a case. Because the truth is probably not that SaaS dies and not that everything snaps back to normal. The truth is that some software companies adapt, some get re-rated, and some discover that AI strategy was mostly a slide deck with suspicious amounts of gradients. Next up is Alibaba, and this is one of the most interesting stories of the week. Reuters Breaking Views reported that Alibaba has split its AI efforts from its cloud business and created Alibaba Token Hub Business Group, led by CEO Eddie Wu. The logic is important. Rather than treating AI as just another cloud feature, Alibaba appears to be building toward a cleaner monetization model around AI token consumption, especially for always on digital assistants and agents. Reuters also reported that the company launched Wukong, a business focused AI platform designed to coordinate multiple AI agents across the enterprise tasks. Alibaba shares rose 2.5% after the news. And this is where the conversation gets much more economically interesting. The market has spent a lot of time asking who has the best model. That is not the only question anymore. A better question is who has the best business model for agentic AI? Because if the future is not occasional prompts, but continuous autonomous activity, then usage economics matter more. Token flow matters more. Compute consumption matters more. The meter starts running in a very different way. And Alibaba, at least from this move, seems to be thinking less about bundling AI into broader software stories and more about capturing the raw economic activity underneath it. And that's a big deal because it suggests that the next software winners may not be the companies with the prettiest AI assistant, but the ones sitting closest to the economic engine powering it. And if Alibaba is rethinking monetization, Nvidia is making a different move. It is trying to make sure the most valuable layer in AI still belongs to Nvidia. At GTC this week, Jensen Huang pushed OpenClaw as a major agentic AI platform and introduced NemoClaw, a more enterprise-focused, security-conscious version meant for workplace deployment. Reuters described Huang's pitch as part of a broader effort to keep NVIDIA central to the AI stack as competition rises from AMD, Google, Amazon, and others. That matters because this is not just a product announcement. It is a map of where NVIDIA thinks value is going, not just in models, not just in apps, but in the infrastructure, orchestration, and enterprise runtime layer that sits underneath autonomous agents. In other words, NVIDIA is not content to sell the picks and shovels. It also wants to say in how the mine is run. And that is the investor takeaway here. If value in AI keeps concentrating upstream, then a lot of application layer SaaS companies may struggle to hold on to old valuation assumptions. The more the market believes that the real leverage sits in chips, infrastructure, security, and orchestration, the more pressure falls on everyone else to prove that they are more than a wrapper. That is not a death sentence for SaaS, but it is definitely a warning that the profit pool may be shifting. And the last story is about IBM and Confluent. Reuters reported in December that IBM agreed to buy Confluent in an $11 billion deal aimed at strengthening its cloud and AI position. The acquisition also boosts IBM's exposure to recurring revenue and doubles down on the idea that real-time data infrastructure will be critical in an AI-heavy enterprise stack. This is a great example of a story that sounds boring until you realize it might be one of the smartest moves on the board, because everybody wants to talk about the AI layer users can see. Very few people want to talk about the streaming data, governance, integration, and real-time movement that makes those systems usable in actual companies. But that infrastructure may end up being where a lot of durable value sits. If AI agents are going to operate across enterprise workflows, they need live, trustworthy, connected data. They need context. They need systems that can feed them in production, not just impress people in demos. And that is why this deal matters. It's a reminder that while the market gets hypnotized by assistants and co-pilots, the quieter winners may be the companies that own the pipes, which is irritatingly unglamorous, but markets do enjoy rewarding the dull machinery behind the magic trick. So what is the signal from this week? It's this: software is not dead, but the old assumptions are. The assumptions that subscriptions alone guarantee safety. The assumptions that all software deserves premium multiples. The assumptions that AI will lift every vendor equally. the assumptions that the app layer automatically captures the most value. This week suggested something more selective and more ruthless. Regulators are scrutinizing the old model. Capital markets are getting tougher. Investors are splitting between fear and opportunism. And the companies that win may be the ones closest to monetization, infrastructure, and real economic leverage in the AI stack. And that's it for this week in SaaS. If you're in software, don't just watch the headlines, watch where the market is moving, where the regulators are leaning, and where the actual value is concentrating, because that's the real story now. And if you're enjoying these weekly breakdowns, subscribe to SaaS Evolved. We cover the evolution of software, AI, markets, and what all of it means for builders, operators, and leaders trying to stay ahead of it. I'll see you next week.